Hello and welcome to episode 16 of the Capital Spotlight podcast. As always, your host, Craig McGrother, and with the one, the only, the author himself, Rob Beardsley, the co-founder and principal of Lone Star Capital. How are you today, sir?
I'm doing well. How are you?
Life's great. Very
There's
excited. We have some very fun trips coming up, which is awesome. So a lot of traveling. We're going to be in person a lot the next month. We've got New Orleans, and then we've got New York, of course, and then Miami. And then do we have anything else sprinkled between?
I don't know. We'll see. The schedule's always in flux, but yeah, it's conference season. We're recording this on October 3rd. So it's conference season. It's going to be the holidays. It's going to be the end of the year before you know it. So this is the home stretch and we've got plenty to do. But yeah, you look a little different. I don't think it's your hair. What's new with you?
I feel like you right now. I'm getting called out because we have something new, a little something right here that's been discussed. It finally happened. And, you've talked about this. Who would have thought that one little addition like this could bring so much happiness and joy? But every single time I go like this, I get happier. And frankly, this thing people must think this is surgically sewed and attached to my arm because it has not been off my wrist since I got it. And it's actually a week anniversary on the day from when I got it. So how lucky am I?
That's incredible. Yeah, well, I mean, you got to get your money's worth, so you need to wear it.
Exactly. And how this came about is your family had a relationship with a Texarkana dealer. Many people ask, wait, where? Who? What? Yes, Texarkana, which is very, very close. It's basically, northeast Texas. It basically borders or is very close to the Arkansas and Texas border, hence the name Texarkana. And the Beardsley family has a relationship there. And fortunately, we got the call and it was an easy decision on my end to make. So for that, we are incredibly grateful and happy. And this is not an easy thing to get. There's memes going on right now on Instagram and such of, where you go into the authorized dealer and you ask him for, a stainless steel sports watch. And there's, I think, like the car guy and someone else laughing at it. So it happens.
Yeah, it's amazing what patience will get you. And maybe we can, if we do talk about watches more later, we could talk about ADs versus the gray market and market values and things like that. But we can nerd out on watches later and
Yeah.
spare people that for now.
And we will go through that. There's a topic we want to go through, just like the portfolio we want to build, not for real estate, but for the watch side and the inventory and how we want to handle that and what we want to do. But with that said, let's get into our agenda because it is actually going to be jam-packed, as always, with a great show for you prepared today. So number one thing we want to start on is a shifting situation where we're not needing to stretch numbers to make deals make as much sense or to actually work, which is the first time we've seen that probably in several years, and you have a better running track of that in your head as to what that looks like on your end, Rob. So that's cool. I look forward to seeing that. And brokers actually coming back around with us for deals that they initially pitched and maybe they followed escrow on. Finally, next is the Tides Real Deal. And that article I was just posted, which is very interesting. And then also WeWork just got released that they have $95 million of payments that they elected to not pay. So they're also restructuring some leases, I believe, as that's an arbitrage play. And then there was a really interesting webinar regarding the gap. So we'll get into that. Treasuries making things very difficult. And then finally, an Aquanaut deep dive. So we will get into some risk and watch talk.
Okay, amazing. Also, they're actually installing wallpaper in our offices here. Do you hear them working behind me?
I did not hear anything at all. We're
Oh,
crystal clear on our end. Yeah. So
all
good
right.
to
Well,
go.
if let me know if it gets too loud or if they come into the room and they want to start wallpapering up this wall, and I'll move over to our podcast studio. But yeah, just let me know about the audio.
Sounds good. Well, on my end, maybe I'm going losing my hearing, but all good on my end. Well, without further ado, let's get it going. So shifting right now from not needing to stretch the numbers to make deals work. So essentially before what was going on is, you kind of hope, want, and pray for deals to make sense with the business plan and whatnot. But now going in, fundamentals are changing. So can you kind of talk to me about what you and Brad are experiencing currently on the acquisition side and maybe just generally what's going on with brokers as the market is shifting, of course?
Yeah, it's amazing, and it hasn't happened yet, but we're in the early stages of this, what I think is to be a transition. So if you rewind back to the post-COVID era of 0% interest rates, we were in such a hot market that you had to pull so many strings and you had to push your numbers in so many different directions in order for the deal to pencil, and you would still get outbid. And then you'd look at the winning bid and go, oh my gosh, how did that group underwrite to that number? What are they doing in their model? So numbers just got so aggressive. The assumptions were so aggressive in order to win deals. And we're seeing that really come back or go away, rather. We're seeing that we're able to get closer to the strike price without even fully stretching all the way that, frankly, we got more accustomed to in a more competitive environment. So I think that's really exciting because deals are going to be able to be purchased, hopefully, with better fundamentals soon in the future. Right now, it's, like I said, a transition period where cap rates still have some more room to expand, I think. And hopefully we get some relief on treasuries, which we can touch on later. But it's going to be a very interesting and unique market environment. Not necessarily unique because obviously the cycle is always repeating itself, but it's going to be an interesting time when it's going to be less about making the numbers work and more about picking the right deal to go with. And this is an interesting topic or thought that, okay, if you're not struggling to make the numbers work, if you can pretty much underwrite a handful of deals and the numbers all look relatively decent, then what is your decision process as far as picking what deal to go with, right? It used to be, okay, let's look at 100 deals and only one of them is going to really pass our financial analysis, and that's the
And
one.
it might barely get there, right? It might be just fractionally have to stretch a couple more things, but when the market is going up in a direction, you just have to be kind of aggressive, as opposed to right now. What it sounds sounds like as if maybe someone's getting a contract on it and then debt's changing, and therefore the sponsor needs to walk away from it because the seller may not want to accommodate a retrade, and maybe you can be the second husband, the second winner on the deal, where you are getting it for the more favorable price. Is that fair to say?
There's all sorts of stuff like that happening. There's a lot less deals on the market, and there's even fewer that are actually transacting. A lot of deals are going to market, and the seller claims to be a market seller, which means that they're willing to sell at whatever the market price is. However, a lot of these quote unquote market sellers aren't actually market sellers because they're not able to face the music. When they actually get the feedback from the broker that, hey, the offers are coming in here, they can't stomach that price and they're pulling their deal. But we're starting to see a trickle of true market sellers, people that are hitting the market and they have to sell for whatever reason. It might be equity driven, it might be debt driven, and those people are selling and meeting the market, and those transactions are well priced. And like I said, I think it's very early days. There's more room to go as far as pricing improving, but I just want to touch on and have more of a conversation about how do you decide what deal to buy if the numbers look relatively good across many deals. I don't want to say all of a sudden every deal looks good in your underwriting model, but
It's
let's
not
just
1 in 10.
assume.
Is it like 1 in maybe like 3 in 100 now? Is it maybe 5 to 10 in 100 if you had a sample batch? What does it look like now?
Yeah, let's just throw rough numbers at it. And like I said, again, it's a transition. So maybe back then it was like 1 out of 100, and then today it's maybe 1 out of 25, and then perhaps in a year from now it'll be 1 out of 5, because prices might come down to such a level where if you plug in the numbers, the deal makes sense. The problem in a year from now is going to be, do you have the courage to pull the trigger?
And the harder component, I would say, is do you have the equity to get the deal done?
Yes, capital and courage, right? The numbers might look good, but do you have capital and courage? So while we're in this transition phase, I think it's very thoughtful. And Brad and I have been having these conversations about how we qualify and how we get rid of deals in our pipeline if the numbers look good. And here's the other thing, right? In this, let's just assume we're not market timers, we're not trying to predict the future, but let's just assume that in 12 months from now, there's going to be a very good buying opportunity. Well, how many deals can you realistically buy at one time in this? Let's just call it another 12-month window buying opportunity. Can you buy 3 deals, 5, 10, 20? It depends on who you are. but you're also constrained by your ability to transact, which again goes down to your capital, your courage, and
Your team.
your team, your capacity to transact. So with all that in mind, you're going to be constrained by, you might have 3 deals on your plate that all look good, but you just don't have the team, capital, courage to do all 3. So in that case, how do you pick which one? Well, to finally share some of my thoughts about this, I think one really important factor is, and this is obvious, but quality of the asset, right? You can start to be more picky about quality, whereas before you would struggle and squeeze to make the numbers work, and you were at the end of the day kind of buying maybe an older asset or an iffy neighborhood, or the business plan you were kind of stretching because you had some comps, but the comps weren't home run comps that you're able to project higher rents with. So those deals you can just discount. You can really focus on deals that make more sense, are the most in alignment with your strategy. And also a really big one is the deals should complement your portfolio. Because if you have the luxury of choice, if you're spoiled for choice for deals, then why not pick the deal that's closer to your existing deals that you already own? Or how about this? Here's another really good point. We at Lone Star want to own more assets everywhere, obviously. Well, not everywhere, in our target markets, which are Dallas, Fort Worth, Houston, and San Antonio. But we only own one property in Dallas. So our operations, our company, our future, and our reputation in Dallas would be much more benefited by a new deal in Dallas than we would by a new deal in Houston, because we already own soon to be 13 deals in Houston. So a 14th deal in Houston isn't going to dramatically change our portfolio makeup in Houston and our operations in Houston. But a second deal in Dallas absolutely would. So strategically speaking, if we have 2 deals on the table, both look good, Lone Star strategically should pick the Dallas one. And then the same goes for San Antonio. We have yet to actually buy our first deal there, but we've planted our flag and decided that that's a market that we want to be in. So again, same thing. If it's the question of strategically, what's better for us, to get our first deal in San Antonio or to add on in Houston? Obviously, both are great, but I think strategically, San Antonio makes a lot of sense.
Gotcha. So my question to you then, because you got into the nuances of, hey, if you're looking at, call it 3 deals and maybe they're all the same, if it's in Houston, Dallas, or San Antonio, you'd be more favorable to the other markets. You'd be favorable to Dallas and San Antonio. But then my follow-up question to that would be, what would you favor? Would you favor a slightly older deal with more value add, with more meat on the bone, or a newer deal that might be, call it a 99 to 2010 vintage that is, I guess on the newer end of the spectrum, a little less meat on the bone? Or would you want someone with a slightly bigger lift, not from an occupancy perspective, but perhaps a higher IRR and more of a value add play where you're kind of creating some more forced appreciation?
Yeah. So it depends where we are. But today, for example, it's very, very difficult, pretty much impossible to get a deal to pencil with bridge debt. And that's just a function of how high SOFR is. And then when you add on a bridge loan spread of, let's say, 350 or 400, you're talking about a nearly 10% interest rate. So I don't really think that there's many deals out there that have strong enough numbers or strong enough value add play to justify a 10% bridge loan, a 9 to 10% rate. So with that in mind, value add's great, but if that pushes you into having to buy with a bridge loan, that's usually going to kill the deal. But that's today. What could happen is 12 months from now, we could see distress for older, mismanaged assets that are owned by owners that do not have the liquidity to properly maintain those assets. And so if those deals fall into disrepair, occupancy goes down and the value of the property goes down. So you can pick those up at a deeper discount than what you could a Class A deal that's well performing. That's just what's going to happen. The Class C deals are going to go down in price and be discounted more than the A deals. So with that in mind, eventually it could turn out that the Class C deal that is mismanaged and requires bridge debt actually becomes a good deal. And that will be a really exciting time. And I think great returns could be done on essentially turnaround plays. But to your point about buying newer, newer is really valuable, and investors in particular love newer vintage. I don't know if you saw John Levy's LinkedIn post today, but he tagged me in it, and he was basically saying that investors are getting tired of 80s product, and 80s is the new 70s, and that investors want 90s or newer. So, and that's all partially true. Not all investors are the same. Certainly there's sophisticated investors, institutional investors that will still play in the 80s space and even the 70s space. But when you can buy newer, it is certainly better. However, I will certainly prioritize quality of the area over vintage. You know,
So your location over basically if it's garden style, podium build, or something of that nature with the construction. So you're just location and kind of story, and you're slightly agnostic, you would say, in reference to I guess the type of opportunity with meat from a meat on bone perspective.
I think to generalize, when you're buying newer deals, you're most likely in a pocket where there's new supply. So you have that headwind, which is no good. So I would much rather buy in a good location with an older deal. And if I can price the risk of the age of the property, I think we're pretty well off. If we recognize, hey, we're buying an old deal, let's make sure that we inspect it properly. We have adequate reserves and contingency to manage boilers, roofs, deferred maintenance that pops up. Then I don't think buying an older property is the end of the world.
But you need to be handicapped accordingly, right? So I guess on the front end, how much would you assess that and analyze that? What is the delta that needs to be there for you to feel more comfortable with one another from an IRR perspective, you could say? Or I guess let's just analyze it from there. Do you need, about 2 points higher than IRR for an older property on a compounding basis, on an annual basis? Is it 3 points? Is it 4 points? Where does that land for you when you kind of do the risk assessment? And then also when optionality hopefully does occur, where would you think that comes into play?
If you were going to compare a 2010 deal versus a 1970 deal, I would say for sure 2 points of IRR. So maybe that's not even enough. I don't know.
I don't think that's enough, actually. To be honest with you, I think 2 points is especially like 70, maybe 70s, like a 76 or something like that. That's one thing, but to that point, I mean, if it's 80s, it's like, oh wow, well, if you hold that for the full 7-year debt term, we're talking about 30s, which feels weird, but that's kind of how you got to analyze these deals, especially in this marketplace, not assuming that there's a clear path and an exit in 2 years, right?
Absolutely. Yeah, you have to be comfortable. I mean, and this is true for all the deals we buy. We have to be comfortable owning the deal for the long term. Even if you end up having a hold period of 24 months, 36 months, you have to buy with the intention of holding long term because that helps mitigate risk. So it is harder to hold older assets long term. Another headwind for older assets is insurance. So insurance costs are going up more on older properties than newer properties because there's fewer players in the space that want to write insurance on those older deals. So with less players in the space, there's less competition, which drives up the prices. So that's something also that you want to make sure that we want to make sure we are baking in properly into our model. And we don't want to be caught on the wrong side of an insurance increase that we didn't anticipate.
Absolutely. So you mentioned something earlier that I thought was really interesting, and I want to dive into a little bit more, which is who are the true sellers versus the non-true sellers right now, right? So what does that really mean? Is that, would you say, more of a debt circumstance and predicament that makes them a true seller, knowing that they can't, raise extra equity for the capital infusion needed? Or is a non-true seller someone's like, yeah, well, you can assume our loan and you can buy your, yesteryear's debt, but we have a 2-year exit on this. Just we conducted our business plan, and we're looking to sell. If we get an ideal, how could you not offer? So could you kind of unpack and break down the true versus non-true market seller in today's marketplace?
Yeah. So to cut to the chase of a true seller, somebody who's motivated, that's going to be mostly debt driven. And we're seeing some of that with people getting out in front of their debt issues. But if you just look at the timeline, right? the over levered bridge loans occurred mostly in late 2020, more so in 2021 and early 2022. So me and you were talking about this last night. To use an example, if you were to say the peak-ish would have been January, let's just say January 2022, just to make the numbers simple. Typical bridge loan has a 3-year maturity. So that means that bridge loan is going to mature in January of 2025. So it's very early, largely speaking, to be talking about a wall of maturities that's going to bring sellers to the market and be forced to sell because their loan is maturing and their options for refi is unattractive. So they just want to sell and they'll take the loss and they'll move on. But we're already seeing some people come to market before their maturity because they're having interest rate cap, escrow issues. And I think we've touched on rate cap escrows on the show before, and that's been a very hot topic, which we'll be sure to talk about at our upcoming summit here in New York in less than a couple of weeks now, about 2 weeks exactly. So these rate cap escrows are monthly escrows required by the lender in order for the borrower to be able to purchase a replacement cap when their interest rate cap that they have in place currently expires. And so even though the initial bridge loan terms are commonly 3 years, a lot of borrowers were doing 2-year interest rate caps. So that means if we go back to our January 2022 example, they could anticipate their rate cap expiring in January of 2024, which is coming up, right? It's actually coming right up. So if you want to get out, if you have a problem, and what that means is if you own a $20 million deal and it has a roughly $20 million loan or what have you, and you need to buy a replacement rate cap, that might be $1 million rate cap that you need to purchase. And if you haven't been escrowing adequately the funds to purchase that $1 million cap in January, what are you going to do? You're going to need to make a capital call. You're going to need a capital infusion of some kind, or you're going to pursue relief from the lender or something like that. Or you could just sell, right? You could sell the deal before that obligation comes up and you can just get out of the deal. So that's what we're seeing. We're seeing those are true sellers that are coming to the market. They need to get out. They have a rate cap escrow. They have a capital crunch. They want to avoid a capital call. And to be honest, a lot of the brokers, what they're telling their clients right now is if you've got a deal that you're thinking about selling, you need to move it now because it's either now or
5 years, maybe. Yeah, 3 years, 4 years.
2 to 3 years, right?
Optimistically, 2 years.
Yes, correct. Actually, that's very right. So yes, values are down today than a year ago, but block that out of your mind. And if you've got something that you want to move it right now. So we're seeing informal processes and much shorter processes occur for deals where if you're a willing buyer, they want to cut to the chase and make a deal happen quickly. And they want certainty of execution because we always want certainty of execution. But in this market, it's no joke. You can't just take the hard money, and move on and then sell the deal at a higher price. In this market,
rates aren't dropping currently where you can get, the best of both worlds. You take someone else's earnest money and then you can sell it for a higher price.
Exactly. You have the stain of a broken transaction, and then you're back out into the market, in which could be a weaker market. So there's major consequences to execution risk. So we're seeing all those factors at play. However, something interesting also, and a bit surprising to me, is the willingness of long-term owners to sell right now. Yes, by and large, there's not a lot of market activity, but I am actually surprised by the amount of long-term owners, people that bought 6 years ago, 10 years ago, 15 years ago, and they're willing to sell today, which I think is kind of crazy.
Yeah,
but
what's their motive, in your opinion? Is it because they're looking to 1031 exchange into another opportunity? Are they looking to sell because they know they have issues in their other portfolio and maybe they're going to hit some promote as a firm, and instead of doing a capital call there, they're going to take their gains there and kind of give it an infusion and not make a capital call, but do a capital infusion to the property so their LPs and capital partners don't have to deal with that, and their kind of capital gets diluted to protect their name. Why would someone like that do that, in your opinion?
I think some of these groups, they, like I said, own the deal for a long time. So they're going to make money on the sale. Their basis is low enough that even though values are down substantially, then from the peak, they still are going to make good money. They're going to make a decent return. And for them, locking in that return is better than just sitting there, I guess. And if they're a sponsor, if it's a sponsored deal, they can make a promote, and maybe it's like, it's kind of, people really do like the timing of the deals. And what I mean by that is people like to sell in 5-year increments. People say, oh, well, we're going to sell based on the market. If it's a hot market, we'll sell. If it's a soft market, we'll hold. But at the end of the day, people do like to be in and out in roughly 5 years. So a lot of people are hitting the market and they're just saying, yeah, we've kind of hit our business plan. We've held the deal for 5 years. It's just time to sell.
Yeah, and especially because our world, the PE world, and a lot of kind of the deals that we look at, it's a 3 to 5 year hold. So kind of look at the amount of transaction volume. That 2020 was a weird year because legitimately nothing happened in Q2 of 2020. And then things were probably pretty slow in Q3, and then Q4 things uptick. But 2021 and 2022 saw a boatload, at least the first three quarters of 2022 saw a boatload of transactions. In 2021, if you were a broker, you probably made more money than you ever knew what to do with. And now you're probably looking around and romanticizing what 2021 was, which is 2 years ago. But with that said, the logic there with that information would suggest that, call it, in 2024 to 2027, there's about to be a plethora of deal flow. Is that a fair assessment?
Absolutely. If you take a step back and think about investing in terms of, people in the investing world, they say vintages for years, right? So we say vintage for the age of the property, but people also talk about different years or vintages to invest in. And if you zoom out at a very high level, I think more importantly than in getting geographic diversification or strategy diversification, vintage diversification or vintage selection is really probably the best way to get alpha. And so 2024,
basically, like dollar cost averaging it is what some people call it, where it's like, hey, instead of being too crazy in a certain year, I want to be strategic about my thought process and investments, essentially, where, hey, I'm not going to get too high in 1 year because things will all kind of average out.
Yeah, I would say that's the safest way to invest, is just basically not try to get too involved in the market ups and downs and just invest consistently every year across the cycle. But if you can kind of read the market a little bit and lean in or lean out accordingly, you can do very well and even better than the great strategy of just dollar cost averaging. So I think if you lean into 2024, 2025, and maybe 2026, I think those will end up, people will look back and look at those years as really fantastic years to invest, just as they look back on 2010, 11, 12, 13. There's a lot of good years to invest. It's not like you have to hit the window perfectly, but I think that's going to be the case coming up for sure.
Yeah, ideally, it's funny, you probably could have gone full cycle twice if you deployed capital in 2013, a 3 or 4 year hold into maybe 2017, 2018, and then hold that for another 4 years, exit in 2022. You've been a very happy person.
Absolutely.
Which brings us into the next segue, which, speaking of stuff that is changing and market sellers or perhaps restructuring of deals, was the Real Deal article that came out, I want to say 2 weeks ago. We've had so many other great topics to speak on. We haven't been able to touch on this yet, but when Rob gets into a rabbit hole, good things happen and his brain starts spinning. And I think your wheels are turning on this one, just kind of diving through and analyzing this. So Tides, and if you want to pull it up right now on your computer, there was a Real Deal article. This is all public, and we don't wish this to happen to anyone in the business, in the space, but this is just inevitable. What does happen as markets switch, ebb and flow and move? But Tides had a massive restructuring with their lender as to how to make these deals work and to pencil. So I would love for you to break down and educate kind of what this means, what happened, what we can learn from, and how investors can be safe. And also, if they feel as if there's something going on with their current investments, ask those sponsors or the correct individuals, the investor relations teams, what's going on with their money and with the deals. So with that being said, Rob, why don't you dive into this article, what you learned, what you found interesting, give us a brain dump.
Yeah. So I spent last night way too much time reading about all this stuff.
Forum king.
And I don't pretend to be an expert in Tides' business, and I don't have any insider knowledge whatsoever. I don't know them at all. So I'm just seeing what I'm reading online, and I can also infer some things just based on my being in the business. So the big news recently was that Tides did a big workout with MF1 on what is people believe 500 million in loans. And what a workout is, basically they went back to MF1 and they said, all right, these bridge loans are over levered on our deals. We're going to have some issues. We can't make these rate cap payments, right? You're asking us to spend, I don't know, on a $500 million portfolio. What would that be? Like $25 million on these rate caps? Well, we don't have $25 million. So what do you want us to do, right? So they're approaching with they're being communicative, which is good, right? They're being a good borrower, trying to work with the lender. And I think what ended up happening is they were able to push out maturities, which that's a no-brainer. That makes sense from all parties' perspectives. And then they also got relief on the rate cap. And specifically what they talked about is they were able to agree upon buying a 6-month cap instead of a 12-month cap. So generally speaking, a lender will require you to buy a replacement cap that is a year long. And that's more expensive than buying 6 months of a rate cap, right? It's just simple math, because if you're buying more insurance, it's going to cost more. If you're buying less, it'll cost less. So Tides came out and I don't want to say bragging, but they're saying, hey, we got this big victory. We're able to buy 6-month caps instead of 12-month caps. And I find that part of the deal not very interesting or exciting, because they're just kicking the can down 6 months. They're going to still have to buy another cap in 6 months, but they avoided paying the lump sum, right? So they scrape together whatever cash they have as they're rapidly making capital calls across their portfolio and to buy this measly 6-month cap. And then 6 months later, bang, there's going to be another big obligation to buy a 6-month cap or a 12-month cap. Their hope is that cap costs come down in 6 months, because hopefully the forward curve comes down or rates come. I mean, we all know, or at least I think we all think that the short end of the curve, the Fed's not going to lower rates in 6 months, right? So in the end, I think this is not a super exciting, oh, they want me to subscribe, and we unfortunately don't have a subscription, so can't afford to see this article.
No.
But I was looking at it last night with my trial.
Austerity measures.
Yeah, that's a little embarrassing. So with this workout, I think the interesting part is they got the workout done with MF1 on $500 million, let's say, on their deals. However, they tried to get similar arrangements done with their other lenders in their portfolio, and those other lenders said no. So I think that is interesting to show you that MF1 has such a large exposure to Tides that it's a situation where if you owe the bank $1 million, the bank owns you. If you owe the bank $1 billion, that's the bank's problem, right? So they're in a situation where they owe so much money to MF1 that they kind of have a little bit of power here, and MF1's willing to negotiate. Otherwise, if they start foreclosing and taking losses, that's going to have a ripple effect across their CLOs that these loans are securitized in. And that's going to hurt their ability to issue new CLOs in the market. So it's going to just totally disrupt their business. And this is why distress and foreclosures are so not simple, and why they take so long to play out, because the lender and the borrower don't want this to happen. They don't want capital to be destroyed, and they don't want to, well, capital has already been destroyed. It's whether you realize it or not. And I don't mean realize it like, oh, I get it. I mean, realize it as in sell and lock in that loss, right? So MF1 doesn't want to foreclose on these deals, and that is the reason why. Whereas other lenders in their portfolio just said, nah, we'll just we'll just take over the deals. Thanks. No need, no reason to work out with you. Right. So that's interesting. Another interesting wrinkle is they've got pref up the wazoo, and they're trying to do these refis and these restructurings. And a part of these restructurings was to bring in pref to help pay for the rate cap. So it's really not a fun situation to be dealing with. And, I imagine they're having a hard time sleeping just because they're under a mountain of debt. And unfortunately, if you kind of dig into their numbers, you can see that there's lots of deals that they own where, quite simply, the debt is not worth the collateral. The collateral is not worth the debt, however you want to
Which
look
means
at it.
the equity will get eaten and someone owes money somewhere, correct?
Well, if you have a deal that their all-in basis is 50 million, or let's say today's value of the deal is 50 million and the loan is 50 million, there's no equity there. If they were to sell the deal at 50 million, there would be enough money to barely pay back the lender and the equity is wiped out.
So what happens to the investor's dollar?
They lose all of it.
Correct. So my question to you is, what happens to deals that do get saved and worked out with that bank? And then what happens to the deals that don't? So the ones that get saved, are they basically just restructuring it to the point where upon exit, they'll have, maybe their investors will get their money back, or maybe is it a situation where they just don't get foreclosed on, or perhaps if there's a miracle turnaround story, some of their investors can make money back. Can you kind of walk us through those scenarios, please?
Yeah, I'm sure they have plenty of deals that have positive equity and will survive. And when I say positive equity, I just mean that the property's value is 5 million or 50 million and $1, and the debt amount is 50 million, right? They might have $1 of positive equity, but at least the equity is positive. And then that means there's a conversation that can be had as far as, is it attractive to try to continue to save this deal? Because what's really scary and kind of a very grown-up conversation is to look at the numbers, look at a deal, and understand that, yeah, you could save it. You could work with the lender. You could extend the maturity, buy more time. But if in the end, you have to put more money into the deal such that your basis, every time you put more money into the deal, your basis goes up, right? If you bought the deal for 50 million and then you had a $5 million CapEx budget, but then you have to make a $5 million capital call to keep the deal afloat, your basis just went up to 60 million, right? And eventually you have to make this analysis that, hey, I can feed this deal and put more money in, but if my basis gets high enough to where my long-term yield on cost is, let's say, 4.5%. I'm just making a dramatic example. I'm not saying this is going to happen to them. I'm not saying they're going to lose money. I think they will, but I'm not saying they're going to. So,
and not hoping for it, for the record.
No, we're not hoping for it. So if your long-term analysis shows that, hey, if we stabilize this deal, we knock the business plan out of the park, but because we had to add so much money to the deal, our yield on cost is, let's say, 4.5%, and the market value for that asset we think long-term is 5%, that means your equity will be negative basically permanently. Not permanently, because maybe eventually you'll get appreciation up to that 5%.
The next market cycle. Yeah.
But that's the analysis you have to make. There's some deals that are just not worth saving. And it's just better to hand the keys back. And the 100% loss is better than 125% loss. And that is, in part, what is potentially likely to happen when you have these situations where they did get the workout with the lender, but to whose benefit, right? Because all they're doing is they're extending and pretending, and they're allowing the lender to not realize the losses. They're allowing the borrower to not realize losses. And eventually, just a workout today doesn't mean they're safe tomorrow, right? It buys time, but like I said, you have to run the numbers and look at what is the long-term outlook. Are we able to get this deal to a yield on cost that is equal or better to where the market cap rate is today?
Right. So my question is, how do you avoid this as an investor and as a sponsor? How do you avoid this circumstance? Is it just basically being more conservative on your debt profile? Is it raising more equity on the front end? Is it being more disciplined with your discretion in reference to green lighting a deal? Is it just basically not buying when certain metrics happen? For instance, maybe when the market gets hot in the next decade from now and the cycle goes, if we've got a couple $1 billion of AUM and we have enough revenue and fees coming in from that, does it make sense just to say, hey, we're gonna take a sabbatical from acquisitions and we're just gonna sit back unless there's a screamer? I mean, how do we play this game correctly where we're recession resistant and we can do everything we can to avoid ever calling an investor saying, hey, we need equity for the infusion of a deal, not we need your equity for a new opportunity that's going to make you a lot of money? I mean, how do we kind of pinpoint the problems here to avoid this and course correct for our end, but for the audience watching, and whether you're a sponsor, if you're an investor, because real estate's the best thing in the world, and like also gonna be the worst thing in the world. And that's just frankly what happens with debt, right? So can you kind of walk us through that?
Yeah. Well, you just said the word at the very end, debt. So you can overpay for a property and not lose money. But if you overpay and then over lever on that overpaid deal with short-term debt, that can cause the problems that we're now seeing today. And, it's overly simplistic and it's a lot easier said than done, because when you're in the day-to-day of the market, it's very difficult to know where you are. Are we in the middle, the peak, the bottom? How long is the peak going to last? People were calling for a recession and for real estate values to roll over since 2016. And people were thinking, wow, it's been late in the cycle. We're ready for another recession, but it just kept going and going and going. So it's very difficult to know where you are. And it is irresponsible to, well, do whatever you want, but it's irresponsible to sit on the sidelines, let's say back in 2016, and say, things are getting a bit hot, I'm going to sit on the sidelines, because then you missed out on incredible gains. So like we talked about earlier, it's better to dollar cost average, to invest across vintages, and to have a more long-term conservative outlook, particularly on your debt strategy. And so that's the lesson that a lot of people are learning now. And it's nice because the cycle goes up and down. And when it goes down, it resets things. And the people that survive are going to be chastened by the experience, and they're going to employ what I think they'll largely employ more healthy, long-term conservative debt standards. And that's going to carry with them for the rest of their lives. I mean, wouldn't you say that the lessons we're learning today will carry on with us for the rest of our lives?
On our end, yes, because we got into a point where we saw the crazy run up, and generally speaking, I know you and Ken are incredibly disciplined, but there's always going to be someone who's eager, ambitious enough, hungry enough, and wants it so bad that they may make an impulse or a short-sighted decision to get going, where they're just buying at the wrong time in the cycle and they get kind of caught with their pants down. So I know on our end what we look for. And, frankly, by I hope this next market cycle happens, we've all done so well that we don't necessarily need to rely upon hitting a grand slam or a home run or swinging for the fences. We say this all the time, and this is my strategy. We're in fortunate enough situations where we see to singles and doubles and buy good deals that make sense from a debt profile. I'm not really a gambler. I've never been. So I'm just looking for good opportunities where I can make, a healthy cash on cash return that's competitive with what the stock market would look like on an annual basis, plus a little back end left with fixed debt. If you do that, you're going to be A-okay. If you have a long-term horizon, it's going to be A-okay. But a lot of people, whether it be those who like crypto or NFTs or whatever it may be, when money gets hot, they start throwing money at whatever because it's a FOMO situation. So I wish we could say this will be an avoided thing, but there's a reason why it's called cycles. It ebbs and flows. There's the yin and the yang. Someone's going to get caught with their pants down, and we just hope it's not us, and we hope it's not of our friends. We hope it's no one who raises capital in our deals that they put their money into. But unfortunately, it is player versus player. What comes up must goes down, and there's going to be a lot of people that lose a lot of money, and they're going to be snake bit, unfortunately, and it will naturally have a rippling effect. And that's why coming up, equity will get very difficult, because they're going to be chasing other situations. They're going to be gun shy. There's going to be potential recessions where maybe they lose their job, or if you're a capital raiser, you're raising half the amount of money before, and you got to be very selective where that money goes. Or they elected to put their money into deals that didn't perform well. Now they're kind of paying the price on that from their investors. So there's just naturally, anytime a market changes, anytime a recession comes, things get funky, and things, yeah, I guess, yeah, things just change. So unfortunately, I wish we could say and kind of bottle this feeling right now, the sobering effect of really what's going on right now. It's kind of, we're in the process of, if you drink alcohol, we rarely drink, of course, on the show, but generally speaking, if you drink, the next day you have a hangover. And the hangover for a lot of people, I think, is just going to start happening right now. And people have to face the music. They've got to look at their receipt from the bar last night where they spent too much money at, and they got to feel emotionally what it feels like, where it's like, oh, wow, I'm kind of punched in the gut here and I don't feel too good. So I think, unfortunately, wish I could say that people would keep this feeling for forever, but that's just not realistic.
No financial innovation, no human, well, I can't say no human advancement, but it's very unlikely that cycles will go away because they're a function of human psychology, and human psychology is unlikely to change. So, but with that, I'm not done gossiping, because
Oh, but there's more.
yes, there's more. So it's also interesting to note that MF1, the lender that did the big workout with Tides, did not do a workout with Rockstar Capital in Houston and instead opted to foreclose on the asset. And this is a situation, and this, we're pulling this up here in James Eng's webinar from, I think, yesterday. So, and we'll touch on more topics in his webinar. He does a great job. So shout out to James. But this deal, as James points out in his video, has struggled on the occupancy front. So you can see it trends around 80% occupancy since they bought the deal. And this is a situation where they were not able to pay the debt service on the loan. And that's a much more difficult situation for the lender to stomach some sort of workout or whatnot. So they had much more need and reason to foreclose. And then also on top of that, Rockstar is a much smaller player and a much smaller relationship for MF1. So I think that's another reason as to why they simply chose to foreclose here and not do some sort of workout. So that's a big thing. Go ahead.
If you get foreclosed on as a sponsor, is that basically the kiss of death and you're kind of, you're 6 feet under? If you have to turn your keys back, I mean, is there any way without basically changing your investment firm's name from, XYZ Capital to Green Capital now? Is that basically a death sentence if you have that on your track record, in your opinion?
Not necessarily. And it all depends on how big you are, and it depends on when the foreclosure happened and the post-mortem. So if you're a big enough sponsor, you have enough wins in your book, and you have a foreclosure that occurred in this period of time, you're going to be able to still, let's talk about the debt first, because foreclosures impact your ability to borrow future. So the reality is, if you explain to a lender, you have a write-up that says, hey, we bought a deal at the wrong time and we used a bridge loan. Our business plan was well-intentioned, but the market turned very rapidly. Interest rates went up a lot. Our equity, we as a sponsor, we were happy to hold on and try to make this deal a success, but our equity just pushed us to just give the keys back to the lender. We worked in lockstep with the lender. We were very coordinated and not combative, and none of the parties involved in the foreclosure ever threatened or attempted to pursue any sort of legal action. Everything was friendly. They made it easy to foreclose. This sponsor is good to work with. They're a good steward of capital, and we recommend to lend the money again. Right? That's very, very doable. So it's absolutely not a kiss of death on the debt front. On an equity front, that's a different question. That's just kind of up to investors whether they want to work with you again. And, that just depends. I do think that people do, in some cases, have a little bit of a short memory, because I have heard stories of people who gave the keys back on a ton of deals in 2008 and then launched a new fund and then went and bought billions. So I think it depends, but it's definitely not, it's not game over.
Okay.
Yeah.
Segueing into, any other thoughts on this one? Because you said he had some more juice.
Yeah, I'm trying to think of the other interesting gossip. that's going on in the market. I mean, it's just the thing is,
Well,
it's kind of frustrating. Is it takes so long,
and
right?
also think about this. If we're catching wind of this now, this has probably been a quarter delayed at least. So we don't even know the next wave and series of folks who make a capital call or will be written up from the good people at the Real Deal, sharing the latest gossip and tea and debt interworkings on maybe restructuring and reallocating of debt and whatnot. So there will be only probably more coming up. It seems like every week there's new information, which brings me to the next point, which is WeWork just announced that $95 million of payments will not be made on their arbitrage like rental flex office space plays. $95 million. And what they basically said that they're going to retrade their current leases that they have currently, which is interesting because that is not helping office. Not that that's the entire leaseor in that space, but just goes to show kind of the turbulence that they're experiencing, the office folks right now. So there's just more unfortunate news in that front. And it's just overall, WeWork had such a sexy name and compelling story and was such a darling at one point that, people kind of read that headline and it just has overall negativity as opposed to that just being kind of a smaller isolated segment of the overall real estate investing world. But it's just something to think about there. It's just not the most positive. Do you have any 2 cents on that front?
Not really. I mean, it's just indicative of the market, and also it's just another example of a major player where they haven't actually executed the restructuring. They're confident, or at least that article that you and I had looked at, they're confident in their ability to restructure, and they're just brazenly missing debt payments, right?
Are
To
they
the
holding him hostage to a certain extent where it's like, all right, what are you not going to pay and good luck leasing it because we know you're not going to? Like, are they kind of just say like are they gambling here almost or just say, you know what, take it, or like you're gonna have to change it? Like, what do you think their strategy is?
I mean, the crazy thing is, and I don't know why I'm using these big words like irresponsible, right? Because I'm not the person here in charge, but it's almost irresponsible for WeWork or the borrower in a situation like this to even pay the debt. I know it's a financial obligation and also it's kind of like a moral obligation, but if we're just to take a dramatic example, which I don't know the details of these ratios and whatnot, but we're aware of situations. It's just simple math where if the office building is worth $5 million, but the loan amount is 10 million, like what are you doing there? What's the point? There has to be a restructuring there. The equity is long gone, right? If the value of the building is 10,
It's so past point of no return, and it's so upside down and egregious, frankly, that it's like, okay, well, we have to come to a solution here and we have to work together because there's just a massive gap. Is that kind of what you're saying?
yeah, and a borrower is not going to work forever for no money. So if the equity is long gone with no chance of anything coming back, why not pay the debt, threaten or play chicken to give the keys back? Because the lender's going to go, wait, keys back on a property worth 5 million when my loan amount's 10 million? I don't want that. I would much rather to restructure, and maybe I'll forgive or resize the loan down to 7, and you keep paying me interest on that 7, right? A lender would rather keep earning interest on 7 than just taking a $5 million loss.
Right.
So that's the office world, which we're not in, but that's indicative of all the restructuring that needs to take place. I mean, the capital destruction is a part of the cycle, and capital must be destroyed in order to reset things and to get things going again.
And it's funny, hot money, very much out of the space. And this is something that we are probably gonna make more content on. I think we need to, as we need to speak to investors more sometimes than operators and sponsors and stuff. But that is the money that you're going to invest in the next 2 years will be the hardest capital for you to push over, but it will be the best capital you'll probably ever invest, at least currently right now, if you're probably sub 35. Because unfortunately, one way or another, we weren't around for the Great Recession that occurred 2008, 2011, if you want to call it, during that gap. However, we are alive, well, and present during what may or may not occur coming up here. It is kind of shaking out, and real estate's so interesting. The stock market can drop like that. If there's a war, if there's a weird event, if there's a black swan event, the stock market, it's fluid, it's like that. However, the real estate market is not a fluid endeavor. These things do take some time to shake out. The lagging effect is real. It's more than 6 months at this point, but the way they've been raising rates like this, it's been nuts. So I think we're in the beginning of this process of seeing things changing and shaking up, which gets us to the next topic, which was, as you mentioned before, from John's webinar, which was the gap, which I thought was really interesting. And some things I want to take away, and we hit on this before, which is so interesting and makes me feel so intelligent. And obviously it's so great being around you because we've discussed this, which was the premise that for the first time now in some time, there is actually a nice spread and delta on Class A, B, and C for what you should pay, which is nice, which should be there. But it is nuts to think, and this is also high. People are in, I don't know, a lot of trouble if you bought a 3-cap deal for a 70s or C-class vintage, right now, because that property is going to get handicapped more and more, as we alluded to prior, as to what we'd want to take on from a risk perspective if we're going to get paid. So with that said, why don't you dive into your thoughts and kind of take us away on maybe what your takeaways were. But that was my biggest takeaway, was kind of how the handicapping is occurring and him breaking out kind of sensitivities. So please take it away, my good friend.
Yeah. So this is something that I've been talking about for a long time, and it's the dispersion or lack thereof of cap rates across asset quality. So when the market gets really hot, there isn't much of a difference or dispersion in cap rates between A, B, and C assets. So in 2021, 2022, we saw that Class A cap rates were 3, I'm just going to use general numbers, 3, and then a B cap rate was 3.5. It maybe even, I don't know. I don't know. I don't want to be quoted here, but it was very tight. The spread was not a big difference. And, B and C, there was just no difference really. So you were ending up paying a lot of money for junk.
Premiums for C's.
Yeah, exactly. And a healthy environment would be one in which there's a risk premium for buying junk. If you're going to buy an older property, you should be compensated with a higher cap rate because you're taking more risk, right? And if it's not a higher cap rate, at least it should come in the form of a higher potential yield on cost in the future by way of more value add, right? Because in some ways, actually, if you're going to buy a stabilized Class A deal, that actually might be at a higher cap rate than a value add B deal. Because as we know, when you buy value add, you pay a compressed cap for the opportunity to push income and stabilize to a higher total return. So we're starting, as James in his webinar that we've got here on the screen, as he's making the claim that the gap is back, and we're talking Class A deals are, if we're going to use DFW as an example, which James is talking about DFW, A deals are like 4.5, B deals are like 5.25, and C deals are like 6. That's a
he also mentioned how Treasuries and with where debt is considering where it needs to be. And he mentioned the hot word of the year, or hot phrase of the year, positive leverage. Mentioned, hey, if leverage is here, if you're a real seller, the cap rate needs to be here for this to transact. Do you want to kind of get into that as well?
Yeah, no, it's a good point. So if we actually look at the table on the screen, we can see that, all right, let's say you are buying a 5.5 cap, which that's generally a pretty good buy today, depending on what it is, of course. And let's say the interest rate today is, which today it's going up a lot. And so let's say today the rate is about 6.5. So if you have a 5.5 cap at a 6, and you're financing at a 6.5 rate, you're financing at a 1% negative spread. So you have negative leverage of 1%. And that means you're going to finance, if you're doing 125 DSCR coverage, that means you're going to get 58% leverage. That's a lot of equity. That's not a lot of leverage. So debt at that level is not very accretive. It's not going to help lever up your returns, right? What's the point of levered returns? It's to be able to lever them up, get more return. And if you're only levering up basically one time, which means half the deal's equity, half the deal's debt, it's not going to push the levered returns up much. And so that's just not ideal. Ideally, we would be financing somewhere, I would say 65 plus, right? 65 to 75 is ideal.
It's just so conservative. It's just, it's crazy. It's a great thing, but it's just, oh my, has the world changed? And oh yes, that will be a very big problem when you think about the fact that people had half the amount of equity in these deals prior with higher pricing. So this
Right.
is just goes to show there's gonna be some very exaggerated problems here coming up, frankly.
It all depends how long rates stay high, because if they just kind of pop up, then pop down, people will forget. But if they stay high for a while, it's going to force sellers to come to the market, like you said, and say, oh crap, rates are 6.5. If buyers are demanding that they finance the deal at 75% leverage, we look, what gets us there? A 7 cap. That means prices would have to come down quite a bit if today people are trying to get away with squeaking a deal by at a 5.5 cap. So with that being said, just we are seeing deals now, like legit being willing to trade for 6% plus, which comes honestly at a big surprise to me, but this is the market we're in. So yeah, I mean, I wouldn't say that the deal has to be a 6% plus to make sense. I think you can still buy deals maybe in the high fives and still be able to pull it off with the value add, but that's where we are. And
When it
that's
goes to
the math.
stabilize yield on cost, but you can get that too. People have different metrics with regards to, firms. Some people like, hey, your stabilize is too low for us. We need to be, an 8.5 or an 8, whatever it may be. And that could just be kind of a disqualifying method, but goes to show that it's just tough right now. And the other thing to think about is a lot of individuals and investors think that rents are incredibly high right now, and there's enough reason to believe that rents will actually come down. So you kind of basically have to buy a wildly under market deal, which is not easy to do in the institutional space that we kind of play in, which is further exaggerating the lack of deal flow that we're experiencing currently. So it's really interesting to see all the metrics happen and kind of just the lack of fluidity currently in the marketplace, which is nuts, which brings us into the next topic, which is treasuries. So we discussed this where, treasuries are really screwing things up. Not to get too into the weeds of what happened to us, but we had an opportunity that did not go in our favor due to 75 bips raising on the debt for us for one of our deals. So we'll maybe revisit that in the future. But with that said, treasuries right now are at about 4.7 for the 7-year, I want to say, and about 4.9 for 5-year, and then 10 years about 4.6, I want to say. If you want to pull up Pensford to fact check me here, that would be lovely. As per Rob Beardsley's, one of the few things that he asked me to do is check Pensford every day. I check Pensford every day, of course. But that said, oh gosh, no, they're up 11 bips today. Lucky us. Okay, so that just moved recently. But with that said, that's very, very challenging. So we've kind of talked about this a lot, but I'm going to ask you a point blank question and give me a rapid fire answer. What happens if treasuries stay here for a year?
What that means is, for those that are looking to finance on a long-term basis, these are the numbers that you care about. If you borrow short, that means you're most likely borrowing on a floating rate basis, and your index rate is actually SOFR over here.
And SOFR, secured overnight financing rate, for those who don't know what SOFR means.
And the Fed pretty much directly controls SOFR. So if people are looking at the news and going, oh, the Fed is raising rates or cutting rates, that's going to directly impact SOFR. It's not going to have a direct impact on treasuries. Direct. There's still a correlation. And just to nerd out a little bit, the 2-year treasury.
Please do.
Yeah. The 2-year treasury is actually a reflection of what the market thinks SOFR will average over the next 2 years. So if you look at SOFR right now is 5.33%. This, I believe, is going to turn out to be the peak in SOFR, because currently the market, while the Fed is kind of saber rattling and claiming that they may have one more hike in them, the market doesn't think so. The market's pricing in a 26% chance that the Fed hikes in November, and that's their last meeting of the year. So either they hike or they don't in November, and I don't think they will. And I think this will be the peak in SOFR. And if you look at what the market thinks that over the next 2 years, SOFR will average 5.15. So basically, maybe there's another hike, maybe there isn't, but over the next 2 years, SOFR is on its way down. Not a lot though, right? That's not a,
So we should get floating rate debt if it's going to go down, right?
it's going to go down, but to float or not to float? That's a great question. And I think we'll address that in next week's show a little bit more.
Let's just put it this way. The only floating I want to be doing is down the river in Oregon, going to the backyard. Okay, that's the only floating in my life that I would like to have. Outside of that, I like long-term debt personally. It's more stabilized. I like to have a more, not to use the G word here, but a more reliable and predictable source of passive and monthly revenue recurring to our partners where they can predict it. We're in the singles and doubles business. Every now and then the ball will hit perfect sweet spot in the bat and go over the fence. But those that, what we're looking to do is doubles and singles for every investment. So with that said as well, I've noticed around Phoenix here.
Hold on, you
and I'm
didn't even let me answer. I know I was running around, but you didn't even let me answer the question.
Okay, answer the question and we'll tie it back to my next thought.
But speaking of consistent distributions, I just love opening my bank account and just seeing those distributions come in and just, oh, that's cool. What about you?
I thoroughly enjoy it because a wise man convinced me on this podcast to invest money into multifamily real estate. And obviously, I like to cook and I also like to eat and sample what I had. And for me to feel confident and to feel very good about what I'm doing here at Lone Star, whether it be when I was selling homes in Arizona, you darn well better buy one when you can afford to do so. And I did that right away. Likewise, when I switch over to Lone Star Capital, I'm like, okay, it's time to put my money where my mouth is. I put a very handsome, not majority, but a very, very nice amount of my net worth into our Lone Star Capital deals, which nicely got refinanced into long-term agency debt with the PFC program, generating investment alpha. That's what we do here at Lone Star Capital. And I feel very happy about that.
Lovely.
Maybe
Yeah.
we'll have to bleep it.
No. We don't have to bleep it. I'm just joking around with the shush, but it's all good. We do seek to create alpha, long-term value, and we work really hard for our investors. So, but with that in mind, okay, so you kind of piqued my interest with this floating rate conversation because yes, SOFR's high. Everybody knows that SOFR is going to come down. The market only thinks it's going to come down a little bit on average over the next 2 years.
That's still not bad though. I mean,
no,
nearly
that's
20
nothing.
bips there.
That's nothing. That's not enough to convince me to want to float today, because if I'm floating based on this index, or I can fix based on this index if I want to do a 5-year loan. So let's say I want to do a 5-year loan and I fix it for 5 years. Boom, I'm saving myself 50 bips right there because I'm indexed to this, assuming the spreads are the same, right?
I have a question for you. So I'm looking at this right now, and please help me make sense of this. So the 2 years shorter, 5-year, 7-year, 10-year, I'm looking at. Why are these set at different numbers? Why is the 5-year lower than the 7-year? But the 5-year, why is the 7-year higher than the 5-year and 10-year? Can you please explain that to me? Is 7-year just more attractive for more people to borrow on? Kind of give me your 2 cents on that and maybe make it make sense to the non-savants of the world.
Okay, perfect. So this is a great opportunity to kind of get into bond economics. So a normal, healthy bond market would see a positive sloping curve as you go further out in maturity. So in a healthy market, which as you can see on the screen, we do not have a healthy market. In a healthy market, you would see the 2-year at 3% and the 5-year at 3.5 or 4%, then the 7-year at 4.25, and then the 10-year at 4.5. And so you'd see a positive slope. It just gets a little bit higher in rate with every step in duration. So, and the reason for that is quite simple, because duration risk is a risk and investors should be paid for that risk. For example, if I came to you and I said, Craig, I need to borrow $100. I promise to pay you back in 30 days. What rate would you charge me? You got to charge me some interest rate, right? So charge me, it's small rate, right? Because it's only 30 days. So what rate would you charge me?
I don't know. What makes sense?
I don't know, call it 5% because you're a friend of mine, right?
Right.
Now, what if I came back to you and I said, all right, Craig, I need to borrow $100. I want to go buy something. I'll pay you back in 10 years.
It'd probably double that minimum, right? Maybe triple.
Right? For 10 years, how much would you you'd probably tell me 15%.
Right. Triple,
right?
Yeah.
So that's the nature of the credit markets and duration risk and having a duration risk premium. So that's how a normal, healthy capital market or bond market works. But what you see here is not that. What you see here is actually an inverted yield curve. And so the yield curve is, generally speaking, the relationship between the 2-year Treasury and the 10-year Treasury. Sometimes people choose to look at SOFR versus the 10-year Treasury, which I think also is very valid. But here you can see the 2-year is greater than the 10-year. And that is actually the number one indication in the entire world that we're going to have a recession. So the yield curve is inverted. It's been inverted for a long time, and it's been deeply inverted. And now, because the long end of the curve here has been going up so much recently, are we starting to see that gap shrinking, right? So we still have an inverted yield curve, but it's uninverting ever so slightly. It's starting to come back closer.
So I have a question for you. When will they technically announce a recession? I know they moved the goalpost on us more recently, but I feel as if we've been in one for some time. Maybe I'm more sensitive to that because I've been in the real estate business for almost a decade now. So you can kind of see some signals. There's the canary in the coal mine, as they say. But let me give some context here. I go out in Phoenix now, and I go to the best restaurant in the world, the oyster cap in the world, Buck and Ryder. And all of a sudden, there's way less of a line. And this is the peak season of being in Arizona. There's way less of a line. There's about half the people. It's not as tricky to navigate. Similarly, to get other restaurants and reservations, there is way less demand now. So that is definitely an indicator. And more deep in the weeds, our good friend Teddy has a membership at Desert Mountain. And like all country clubs in America, has really benefited substantially from COVID. There's stimulus. A lot of people have been playing golf. It was one of the great things you could do outside during that process. But what also happened for the more successful people, country club memberships were something that were selling like hotcakes. You literally, the waiting list became egregiously long for some of these places. Well, Teddy just let me know that there's now all of a sudden no more waiting list to become a member at Desert Mountain. That's a very good indicator of what's going on. My dad, who's seen this movie many, many times, likewise to your dad, was laughing at this. He's like, yeah, it's really funny. There's waiting lists at all these country clubs. That will change very soon. I'm like, well, why? He's like, because the market is humming right now. When this changes in the recession, there will be no waiting list. So Craig, you better put your name down on one of these places soon coming up so you can be a country club member, so on and so forth. That's one of my goals, of course. That's actually my decade-long goal, and my 30 to 40-year goal is to become a member of a club somewhere. I digress. But nevertheless, my question to you is, with that anecdotal background, I don't know if you're seeing stuff similar to New York, but when do you think they're going to announce that? Because the reason why I bring that up is once they announce a recession or that starts occurring, rates start to drop. So when do they announce that? Are they just pretending we're not in one for political reasons, not to get too in the weeds of manipulation in that regard? This is not a political podcast, but what is your take on all that?
Yeah, I think that it's a bit subjective because of, unfortunately, numbers can be manipulated. And so I would say, yeah, pretty much you're right. But if we're going to stick to the numbers, and the reason why I say pretty much you're right is because while GDP is still nominally positive, inflation has been higher than nominal growth. And so that means on a real basis, growth is negative, which means recession. And so technically speaking, you need 2 consecutive quarters of negative growth, and that's a recession. I think if we're all being really honest with ourselves, inflation is more than what they state. When they say inflation is 2%, 3%, 4%.
What they use to factor inflation is the most antiquated model ever. Like they choose very silly things.
It's not antiquated. It's just purposely manipulative because, I mean, it's silly, right? Because when they use a fair basket of goods and they're utilizing the cost of a roast chicken
and eggs, right, or whatever,
and eggs or something, right? But then they can use substitute goods and they can actually say, you know what? We can just swap out the chicken for tofu or whatever, or non-organic to organic.
When a Ford Bronco is trading for $30,000 above the sticker price on an addendum, that's how you know inflation's a massive issue. Now, granted, there were supply chain issues as well, but that was kind of a thing where when I got a car, I was like, I kind of want a Ford Bronco. Let's take a look at them. And they were trying to say, yeah, you can buy a base model for $25,000 higher. I'm like, wait, I could buy an X5 for the same price. You are ludicrous. So that just was another reason as to how absurd that is.
Yeah. So I think that when are they going to announce it? when the numbers that they use to calculate things actually say a recession. So what we're seeing is GDP is slowing and it's coming down closer to 2% growth, but so is inflation. Inflation's coming down as well. The inflation prints are also going towards 2%. So we're kind of right there on the cusp of neutral, and then we'll probably dip into recession, but inflation will come even down more. So it's a touchy thing. I don't know when it's actually going to happen. I think it'll happen in 2024. But to tie your point back to rates, because you mentioned something very true, which is in a recession, the long end of the curve normally goes down. So specifically, let's just point out the 10-year Treasury. In a recessionary environment, particularly when stock prices come down, what people typically say is that people flee to a safe haven. And what is the safe haven? Well, it's government bonds, because the US is a great entity to lend your money to because they pay you back, and the government is people trust it. And so they are, when they're in fearful times, they want to buy 10-year US Treasury bonds, and that forces the yield on the bond down. So what we can anticipate is when we do head into recession, we should see the long end of the curve, these 5-year, 7-year, and 10-year bonds, we should see them come down. But I would say mostly on the 10-year, probably. I mean, everything will come down. That's kind of where my bond expertise ends. So that's an interesting point, connecting it to recession. And of course, we have the inverted yield curve, which points to recession. So a lot of interesting things to tie in there, kind of with that recession talk.
Very cool. Well, segueing to something that is certainly not what I would consider an inelastic good. Let's go into the Aquanaut deep dive. So let's get into that. You brought in two pieces, and we'll also maybe talk about this little Batgirl on my wrist. Maybe I'll be Bruce Wayne for Halloween. But with that said, why don't you show us? Well, let me just start with this, and then you can kind of seal the thunder with the beautiful Patek Philippe's. But just to go back, this is the Batgirl, beautiful piece, Jubilee bracelet, very elegant, goes with everything. It's a utility watch, it's sporty. Definitely watch. It has been, as I said, surgically attached to my wrist. So I've been wearing this to the gym, been doing everything with it, basically doing everything but sleeping and showering in it. And even though every now and then I will shower in it as well, but I can't take it off my wrist. I just love it. It is such a great piece. Speaking of a piece that is not as durable as this, as I said, the Aquanaut. So why don't you show us the two different Aquanauts, maybe why you made the switch, and we'll end with that.
Yeah, sounds good. And just to let everybody know and remind them, a couple episodes ago, we highlighted the Batman, which is very similar to your Batgirl. And that was
Correct.
a piece for our friend Zach. And
if you're looking to buy any Rolexes, Patek Philippe's, or Audemars Piguet's,
yep,
can get you sorted.
And if you have watches that you'd like to sell that are lovely pieces, we'd love to buy them. We'll buy your whole collection. So if you'd like to buy or sell, let us know. We'd love to do business with you. And of course, if you want to invest in real estate, which is not as important as watches, but if you want to invest with us, you can also reach out to Craig as well. But without further
CRAIG at lscre.com. Once again, CRAIG at lscre.com. You can find me there. Should you want to be raising capital or become an LP investor in our deals or anything in the nature, if you want to just talk real estate, if you want to run some ideas off me, shoot me an email. I'm very open to connect.
Beautiful. So without further ado, we're going to talk about a very beautiful piece, which is the Patek Philippe Aquanaut. And what we have here are two examples, one being the 5167R. These are both rose gold models, which means R.
So I didn't realize this, but is the shape ever so different on the face? It looks like there's a slight, because if I saw that on your wrist, not side by side, I'd think they're the same watch, but the shape actually looks slightly different on the face there. Are you noticing it as well, or is that just coming off interesting on the camera?
It's just the camera there. This is slightly larger, ever so
looks
slightly.
a little bit wider on the timepiece, not the Tiffany stamped piece. Is that correct? Or am I
It's
just
just a
going crazy?
little bit bigger of a
Okay.
case size, but the size and dimensions are very similar. So starting with the base model, if you can call it that, this is a 5167R. And so basically the reason why it's a base model is because it has limited complications. It has a date window and it has a central seconds. So
Okay.
that's the model. Mine here, very specially has a Tiffany stamp at 6 o'clock. And that just signifies that this was sold at a Tiffany retailer. It was actually sold out of the San Francisco Tiffany store. And so Patek Philippe, to nerd out with you real quick, has a near 200-year history with Tiffany & Co. And Tiffany & Co. was the very first retailer to sell Patek Philippe's in America. So they have a very special relationship. They brought Patek to the market, and uniquely, Patek holds Tiffany in such high regard that the pieces that they give them to sell at their stores, before they seal up the watch, they stamp a Tiffany logo over there down by 6 o'clock, and then ship them off. So it's very...
how many Patek Philippe's are made a year? Because Rolex obviously makes more. They're not, obviously made in mass production, clearly, because you can't go to an authorized dealer and procure one like would be reasonable. You're going to go to a store and you'll see Expedition only, which is the biggest buzzkill ever. But so similarly, Audemars Piguet and Patek Philippe make less watches. How many a year do they make? And then specifically for Patek Philippe's, how many of them had the rare stamp on the face?
So it's estimated that Rolex makes around 1.1 million in watches per year, which is actually a big number. And the majority of, not that I really care about this, but the majority of the components and the way that a Rolex is built is actually not by hand. Because, they're making 1 million of them every single year. That's a lot. But like to your point, even though they make 1 million a year, demand exceeds supply. So there's more than 1 million people that want to buy a Rolex every single year. So that's how they're able to keep such high demand and keep the Rolex name so strong and valuable. However, to take it to the next level, Patek only makes 50,000 watches per year, 5% of Rolex volume per year. And surely there's more than 50,000 people per year that want to buy a Patek Philippe. So, and most of Patek, the process is made by hand, etc. So, I'm not trying to say, Patek is so much more special than Rolex, but...
Well, I will say this, Patek is very interesting. Patek is, I didn't realize the beauty of them until you've kind of shown me them. And I used to kind of think they were a little bit more synonymous with, Audemars Piguet. But I will say Patek definitely feels like a notch above Rolex, but I do like Rolex more than Patek or Audemars Piguet AP. And I think you and I are both in alignment on that. I think Rolex for the price has, incredible watches. Patek are a different price point, but incredibly beautiful and definitely rare.
So with that being said, the Tiffany stamp, and there's only 6 retailers that sell Patek. It's only 6 Tiffany stores in America, I think. And they're actually closing, I think, the San Francisco one. So
I wonder why.
Yeah, I wonder why. So it's estimated that a Tiffany stamp Patek makes it 50 to 100 times more rare than a non-Tiffany stamp. So some people don't care about it. There's actually quite a bit of drama surrounding Tiffany because of the recent LVMH acquisition. One of Bernard Arnault's sons is now running Tiffany. I think Alexander is now running Tiffany & Co. And after they released the famous Nautilus that has the Tiffany blue dial, there's been a lot of controversy and a lot of people have been turned off by Tiffany, actually. So some people actually don't like this anymore, but by and large, the market still thinks that this is a very special addition to the watch and makes it much more valuable, much more of a collector's piece. So anyway, that's a little bit of a Tiffany digression. What we wanted to get into is the difference between the 5167 versus what we have here is the 5164. So this
and why did you make, I guess, can you please walk us through the difference and why you're opting actually to sell that piece? If you are looking for a Patek Philippe and an Aquanaut, you have one on the market right here, of course. Why do you want to sell that piece? So just for everyone's clear, you're going to keep the Tiffany stamp. There's a lot more of a rare nature to it, but you're going and opting for the more simple profile on the face. So can you kind of walk us through the decision and where that fits into your collection, essentially?
Yeah, exactly. So just to highlight the differences so we can kind of set the stage, right? You have date window and then simple hour, minutes, seconds. Here we have hour, minutes, seconds. We have a date wheel at 6 o'clock, not a date window. We have a date wheel. And then we also have the travel time function, which is the main element of this piece. And so what that means is with the buttons on the side, you can quickly adjust the hour and you can now have a dual time zone watch. So currently we're showing here, it's just
Like this.
Yes, a GMT. Exactly. These are the same watch. It's a travel time. You can do two time zones. So let's say I'm in New York today and I'm going to fly to Los Angeles. So what I would do is I would actually want to set the watch back 3 hours to the local time in Los Angeles. So what I would do is I would hit the button. I would go 1, 2, 3, and now very easily and very quickly, I am now in LA. And what you saw also by moving the hour hand is you saw a skeletonized hour hand reveal itself that is still pointing towards 4 o'clock. So now I'm officially telling 2 time zones. And what makes this even more special is that we have 2 windows here. Sorry, I'm shaking so much. We have 2 windows here, one here and one here for home and travel. And so it will show me the day or night. And you can see right now it's both day and day in New York and LA. So both boxes are white. But if I were to move the hand into nighttime, then the box would show up as dark and it would be PM. So
very sophisticated.
Very sophisticated. It's a very cool travel time complication. And this is what stole my heart. And this is what I bought for myself. However, what I realized, and I could only learn this through personal experience, and this is what it means to be a collector and what it means to understand watches at another level. What I realized is the watch doesn't do it for me anymore. And my uncle was right. My uncle told me when I said, this is my dream, this is what I'm going to buy. He said, that's a good choice. It's a beautiful watch.
However,
you're gonna get tired of it. That's what he said. He said you're gonna wear it a few times and then it will start to annoy you.
is that due to the complication and the lack of simplicity on the piece itself, would you say? Or what made him so confident in that decision as someone whom has navigated many purchases and as a collector himself and as a Patek Philippe specialist?
So he cited the rose gold as an issue and also just the busyness of the dial. So here you have the date wheel, you've got the dual time zone feature. And then what I originally thought was the major plus were these buttons on the side, these pushers to balance out the.
I think that would annoy me.
But it creates a symmetrical watch, right? Because you have the symmetry between the pushers and the crown. However, at the end of the day, I like this asymmetrical look better. I like the simple dial better. It's much cleaner. It's much more legible for whatever reason. So it's just interesting how spot on my uncle was. He was so right. He told me, he said, this is the one to get. But my inexperience and also just my youth that tells me, no, I need the bigger one. I need the one that's more complicated. I like more buttons and arrows and all these functions, right? And my uncle said he was there too. He liked bigger watch, more complicated. But now my uncle wears steel, simple, clean.
He's not wearing Richard Millet's or Jacob & Co. watches?
No. So there you have it. That's the analysis. If you look up online, Patek 5164 versus 5167, it's a age-old debate, and a lot of people actually prefer this one if you read on watch forums and stuff. And so this is my official opinion, is that I prefer the 5167, and this is the one that I'm going to keep and wear, and that's the one I'm wearing today. I'm actually going to Rutgers tonight to go and speak in a room at the Rutgers Real Estate Club, and so I'll be wearing this watch and not this one. However, I'll be actually selling this exact model. So if you are interested in this piece, I think it's a lovely piece.
Wait, you're not going to wear both of them on your wrist like this? And so you really know what time it is?
Yeah, I need 3 time zones, perhaps.
Perhaps, yeah.
So
this, yeah. And let me know when you're done, and I'll also show the complication on this watch as well, which is cool.
Yeah, I actually would love to see the complication on that one, because that's the original travel time. Like the GMT, we'll nerd out on the GMT in a second. This is going to be people who aren't into watches, I hope, have turned this off already.
Yeah, exactly. You wouldn't go this far. Yeah,
you wouldn't go this far.
Real estate talk's done.
So just to wrap it up, if you are interested in buying this piece, we'd love to work with you. We'll have it polished and you'll get the best price, and we'd love to do business with you. And perhaps you want to do a 1031 exchange. Perhaps you want to trade in a piece and walk out with this one.
Yeah, if you have a Panda Daytona, we have a good buyer. I think Rob would take one for a reasonable price, and we could help you dollar cost average it in. We could conduct a 1031 exchange, as you're likely in the market for just a simple steel watch at some point. Our authorized dealers who helped us get this piece will be getting a call, and they may laugh at us asking for a Panda, but hey, you got to start and ask something
Hey,
for
I'm on the
something, right?
list. I'm on the list.
Exactly.
So
Precisely.
with that being said, if you agree with me and you want to buy the 5167, whether it be in steel or in rose gold, we're more than happy to work with you on that. And again, we're quote unquote in the watch business just out of fun. We're not here to make money. It's just to have a fun time.
It's to spread the gift of love. Yeah.
Spread the curse,
The
spread
joy.
the disease of watch addiction. And we want to.
Yeah, what did I tell you right when I got this piece like a week later? What was I already saying I want? And I was like, even the last couple of days, what have I been screaming and crying for?
Yeah, another watch. You want a day date.
A gold day, which is disgusting. It's so frivolous. But with that said, going into this piece right here, so you see the skinny blue arrow or arm. That is the military time for an extra time zone. So I have to actually set that to Arizona's time, which is currently same time as it is in California. It's mountain time, but weirdly that time zone never moves. So during daylight savings, I'll never move that. So if I'm in New York, I'll just change it 2 hours up during daylight savings, or likewise, maybe move it back if I'm going to be in California. But it's a really cool function that doesn't change. Here, very simple and clean watch. You've got the date there, glows up nicely, but this watch is just so versatile. And then also you can do I think it's an extra time zone if you move the bezel around as well, which is pretty cool. So it's a very complicated watch, and this watch was actually needed for pilots. So this is like the first pilot's watch that was created, which is really cool history regarding that. So leave it to Rolex to always have a nice and fun and cool story, and also tactful. I remember they needed a watch that could stand a lot of pressure. I believe that's how they made the James Cameron one and the Titanic. The boat could probably use the dimensions, or the submarine could have used the dimensions that the watch had. That's another topic for another day, of course, but it's very cool. There's a lot of stories regarding the Rolex pieces that they make. Obviously, the durability of this watch, nearly indestructible with a ceramic bezel juxtaposed to the delicacies of the Patek Philippe's, very scratchable and whatnot. So that is, if you are someone that's batting around that Patek Philippe's not the watch for you. It would be a more of an occasional wear, as opposed to a Rolex like this or an Explorer or Submariner. They can take a lot of damage.
You're absolutely right. And yeah, the pilot thing is so cool. The original Rolex GMT is the very famous Pepsi, quote unquote. And it's reason why they call it a Pepsi is because it has a bezel that is blue and red.
It might have been a Coke, actually. The first one could have been the Coke, which is black and red. I don't know if that was the first one, but there was a Coke, and then it switched to the Pepsi.
No, so the original was Pepsi because it was originally made specifically in partnership with Pan Am for Pan Am's pilots.
Yes. That's what it is. Okay.
Right. In the 60s. So they made this watch for pilots because they're always traveling to different time zones. And it was with Pan Am's colors, which then was later nicknamed Pepsi. So not to say that you're Batman / Batgirl, which the reason why they call that watch that is because it has a blue and a black bezel, right, for Batman. That's a great choice. That's a beautiful piece. I think it's much better looking. Not much. It's better looking than the Pepsi, but the Pepsi is the horologically more significant piece. It's the kind of more special watch. And what's interesting is, this is not even my uncle saying this. This is actually Nico Leonard, who's a big watch guy on YouTube. He said that the Pepsi is meant to be on a Jubilee because that's how it was original. And I don't even know if that's true, but I can't picture it. But then the Batman as original was meant to be on Oyster. So that's how you're supposed to do it. Obviously, knock yourself out, do whatever you like. But I personally love the Pepsi, and I would consider getting a Pepsi. I would consider getting a steel one, and I would also consider getting the white gold one with the meteorite dial.
Right. Beautiful piece. And What's interesting is the Batgirl came into production in 2019. So this is only a 4-year-old design and watch for this specific GMT with having the coloring of this. So just a cool, unique little story. And, it's funny, this thing trades almost double what the retail price is. So thankfully we got it for MSRP retail through the AD, which is awesome. So nothing like finding some instant equity. It's like finding an off-market deal, basically, that you're wholesaling and tying up, but I will never sell this piece. So
Yeah, that's beautiful.
the collection begins.
The collection begins, and watches are a very fantastic asset class. No, there's no cash flow, but they're a lovely asset class. Good little diversification.
Exactly. And it adds a little pep in your step. And with that said, thank you so much for listening to episode 16 of the Capital Spotlight podcast. We look forward to seeing you next week. And also we hope to see you at our event coming up here in New York City at the One World Trade Center. For everyone who watched, thank you so much. Like, subscribe, comment, leave us some feedback if you have any. We'll catch you on the next episode.